skyscrapers are built with like massive counterweights inside them.
Right, the ones designed to let the buildings sway in the wind.
Exactly, yeah. So they don't just snap under pressure. And that's basically how the global market is supposed to work.
The system absorbs the shock, sways a little bit, and stays standing.
Right. But what happens when the wind is this sudden geopolitical crisis and the foundation is, a multi-billion-dollar artificial intelligence arms race?
And suddenly, the building is swaying in 3 completely different directions at once.
Yeah, exactly. It creates this structural stress test that, honestly, algorithms and human traders alike just struggle to quantify.
Because you are suddenly playing a completely different survival game than the one you prepped for on Friday afternoon.
And that is really the perfect description of the whiplash you might be feeling if you're looking at the global markets right now. So, welcome to Weekend Recap. I'm Daniel.
And I'm Mira.
It is Sunday evening, April 26th, 2026. And our mission for this deep dive is pretty straightforward. We need to help you understand the macro baseline you are operating against as we enter this completely new week.
Right, because we are going to unpack how the absolute, euphoria of Friday's tech-driven market collided head-on with a weekend filled with just massive geopolitical breakdowns.
And domestic shocks, too. I mean, the macro puzzle has been entirely scrambled over the last 48 hours.
Yeah, and we really need to map out exactly what the new picture looks like for you.
But before we formally open our first session, I just have a quick but mandatory reminder. Our discussion today is strictly for market context and educational purposes.
Right, just context.
Exactly. This is not personal investment advice or a recommendation to buy or sell anything.
Okay, so let's establish the baseline. We should formally open Session 1 with our framing question.
Which is, Session 1, what drove the market's V-shaped recovery this past week?
Well, Friday really felt like the market collectively exhaled,
Yeah, it was just green across the board, like shaking off a lot of the anxiety from earlier in the week. But for the listener, what did that actually look like in the raw data?
It looked like a relentless, aggressive bid for risk. I mean, the S&P 500 closed at 7,165.08.
Which caps off, what, a roughly 9% gain over just a single month?
Exactly, and the NASDAQ surged even harder. It closed at 24,836.60.
So up an incredible 14%. Wow.
Yeah, 14%. And this happened right alongside the depreciating U.S. dollar, which closed at 98.49.
Okay, and the 10-year Treasury yields were nudging lower too, right? Down to around 4.31%.
Correct. And when you see equities surging while the dollar drops and Treasury yields cool off, that tells us the market has fundamentally changed its mind about a major underlying threat.
Right. And the data really backs that up completely. For weeks, equities were basically being choked by the fear of a worst-case oil supply shock.
Right, essentially bracing for a complete closure of the Strait of Hormuz.
Exactly. But by Friday, the market had pivoted. It started pricing in a conditional de-escalation in the Middle East.
And when oil risk premia fall, meaning, that extra price baked into a barrel of oil just for the fear of disruption, well, the broader fear of sticky runaway inflation also cools down.
And that translates directly to the bond market, right? If inflation fears drop, Treasury yields stabilize.
Precisely. And when yields stabilize, investors become much more willing to hold duration growth stocks.
Right. Those are the companies where the massive financial payoff is expected, like years down the line.
Exactly, Daniel. Because when interest rates are high, waiting for that future money is incredibly expensive. But when rates look stable, investors just flood back into those growth assets.
And Friday's optimism wasn't just blind hope either. It was anchored in tangible diplomacy.
Right. The U.S. and Iranian delegations were actually on the ground in Islamabad, Pakistan.
Yeah, holding indirect talks. And President Trump had dispatched his envoys, Steve Witkoff and Jared Kushner, to pursue a deal regarding the Strait and enriched uranium.
And we saw the relief in the energy markets immediately. WTI crude settled at $94.40 on Friday.
Right, because the market looked at those diplomats in Pakistan and essentially concluded that the worst-case tail risk was off the table.
Because fundamentally, markets price physical disruption, not diplomacy. As long as the oil keeps flowing, the market is happy to just ignore the political rhetoric.
But, diplomacy was only half the story on Friday. The other engine pulling this market higher was tech.
Oh, absolutely.
We are watching AI-capex as an existential arms race play out in real time. Like, Google committed to investing up to $40 billion into the AI startup Anthropic.
Which is a staggering number.
It is, but the detail that really jumped out to me wasn't even the dollar amount. Google is providing Anthropic with at least 5 gigawatts of computing power.
Yeah, 5 gigawatts.
Wait, 5 gigawatts? I mean, I need a frame of reference for that, Mira, because that sounds like the grid of a small country.
Well, it essentially is. A typical commercial nuclear reactor produces about 1 gigawatt of power.
Oh, wow.
So Google is committing the equivalent of 5 nuclear power plants worth of electricity just to run Anthropic's next-generation models.
That is insane. But I guess we know that the AI build-out constrained by power grid bottlenecks is a major ongoing theme.
Exactly. So securing 5 gigawatts of dedicated compute is just a massive competitive moat.
It really shows that these hyperscalers are operating on a completely independent corporate investment cycle. They're deploying capital regardless of what the broader economy is doing.
Right. And we saw the hardware side of that equation validate the spending too. Intel released their Q1 earnings showing double-digit year-over-year growth in their AI business segments.
It just creates this feedback loop of sheer capital velocity. But I actually want to push back on this euphoria for a second.
Okay, go ahead.
Because Friday afternoon also brought a massive counter-narrative that feels like a glaring warning light to me.
You're talking about the regulatory filings.
Yes, exactly. Scion Asset Management, which is Michael Burry's firm, disclosed a $47.4 million put position on the iShares semiconductor ETF, the SOXX.
Right, which is a massive, highly leveraged bet against the very microchips powering this entire rally.
Right. So how do we interpret that? I mean, is Burry's leading explanation just mistimed? Or are we treating AI megacaps as an index fortress where we just assume their growth is so guaranteed that they are impervious to a market crash?
Well, that is the defining tension of the tech sector right now. The hyperscalers are definitely proving that their forward earnings are somewhat insulated from a regular economic slowdown.
Right.
But, discount rates as gravity on valuations is a rule that never goes away.
Okay, explain that.
Well, think of a stock's valuation like a helium balloon. When the risk-free interest rate spikes, or if growth projections miss by even a fraction, it changes the gravity in the room. The balloon compresses.
Ah, multiple compression.
Exactly. The company's still making money, but investors are suddenly willing to pay much less for every dollar of those future earnings.
So Burry is essentially betting that the rubber band has been stretched so far into perfection that any minor delay in infrastructure delivery will just cause a violent snapback.
Exactly.
Wow. Okay, so to synthesize session one, Friday ended on a wave of immense relief. You had the tech sector firing on all cylinders, you had inflation fears cooling, and you had real diplomatic momentum in the Middle East.
It felt like the macro baseline had finally stabilized.
It did. But that Friday optimism was built on a very fragile premise, which was the assumption that the diplomats in Islamabad would actually succeed.
Which brings us perfectly to session two. So session two, how did the weekend's geopolitical shocks upend Friday's baseline?
Well, if we look back at our Watch Next items from Friday's closing bell, we were supposed to be focusing on incredibly mundane data entering Monday morning.
Right, we were prepping for the Dallas Fed Manufacturing Survey, a routine slate of Treasury bill auctions, and the Fed H10 foreign exchange rates.
Yeah, but everything that happened over the weekend completely hijacked that narrative.
It really did. The diplomatic hope that sustained Friday's rally shattered almost immediately.
What exactly happened?
Well, on Saturday, the indirect talks in Pakistan completely collapsed. The Iranian delegation left Islamabad without making a single concession to U.S. demands.
Oh, wow. And how did the U.S. react?
In response, President Trump abruptly canceled the trip his envoys, Witkoff and Kushner, were supposed to take. He publicly dismissed the Iranian proposal as a, quote, worthless document.
A worthless document. Yikes.
Yeah. And immediately after, Iran's foreign minister Arachi pivoted away from the West entirely. He headed to Oman with plans to travel onward to Russia.
Honestly, Mira, watching this breakdown unfold over the weekend, it felt like an unpredictable natural disaster hitting the markets.
Oh, really?
Yeah, just a sudden random lightning strike of bad news that no financial model can account for.
Well, I mean, that is a very natural reflex, but it is actually the wrong way to view the board.
Why is that?
Because this isn't random. This is geopolitical brinkmanship as game theory leverage. neither side actually walked into Islamabad ready to make a final deal.
Right, they were just feeling each other out.
Exactly. Both sides were simply testing the perimeter to see who would blink. And when neither did, they went back to building physical leverage to force the other into a corner.
Okay, let's lay out the facts of that physical leverage then, because the standoff escalated dramatically over the weekend. How is that leverage being applied in the real world right now?
Well, on the U.S. side, Defense Secretary Hegseth is enforcing a strictly ironclad naval blockade.
And this isn't just posturing, right?
Not at all. The U.S. Navy has actively intercepted and turned around 34 ships attempting to navigate the Strait of Hormuz.
34 ships. Wow.
Yeah. And President Trump amplified that physical pressure by warning that if Iran doesn't move its oil, their energy infrastructure will explode in a matter of days.
But Iran is aggressively countering that leverage, too. I mean, over the weekend, they physically seized a ship suspected of cooperating with the U.S. Navy.
Right.
And perhaps most concerning for the energy markets, satellite data now shows that over 4 million barrels of Iranian crude have successfully exfiltrated the U.S. blockade line.
Yeah, that's a huge deal.
It is. I mean, how do 4 million barrels of oil just sneak past a naval blockade?
Well, it is not about outrunning a destroyer, Daniel. It is about deception. You are looking at dark fleets.
Dark fleets.
Yes. Tankers that turn off their transponders, spoof their GPS locations, and conduct massive ship-to-ship transfers of crude oil in the middle of the night.
Wow.
It proves to the market that a blockade is incredibly difficult to enforce with 100% efficiency.
And as if a physical naval standoff wasn't enough, we saw secondary geopolitical pressures surface that directly impact global oil supply.
Right, the sanctions.
Yeah. On Friday evening, U.S. Treasury Secretary Scott Bessent formally ruled out extending oil sanction waivers for Russia, as well as denying a one-time waiver for Iran.
And for the listener, a sanction waiver is essentially a permission slip from the U.S. government, allowing certain countries to buy restricted oil without facing massive financial penalties.
Exactly. So by ripping up those permission slips, Secretary Bessent effectively removed a massive safety valve on global crude supply, literally right as the physical blockade in the Middle East is tightening.
And the geographic footprint of the risk is expanding rapidly, too. We also saw escalating weekend strikes between Israel and Hezbollah on the northern border.
Right, with Israel destroying buildings in Qiyam and Hezbollah publicly stating they refuse to wait on, quote, failed diplomacy.
We often talk about defense stocks as geopolitical proxies, and honestly, this weekend is exactly why those premiums exist.
Absolutely. But as if the global macro picture wasn't complex enough, we also had a severe domestic shock right here in the U.S.
Yeah, that was jarring.
Saturday night at roughly 8:35 p.m. Eastern Time, outside the White House Correspondents' Dinner in Washington, D.C., an armed suspect actually fired a shotgun at a Secret Service agent. It's terrifying. It triggered an immediate panic and the emergency evacuation of President Trump and his top cabinet officials.
So what are the actual facts on the ground right now?
Well, the suspect is in custody and the president was unharmed. Trump later released a statement explicitly saying that the incident would not deter his focus on the Iran war.
Right. But from a purely market mechanics perspective, political violence targeting the executive branch introduces sudden, intense domestic political instability into a macro environment that is already fracturing.
Yeah, markets absolutely hate uncertainty. And an assassination attempt on a sitting president is a tail risk event that algorithms simply cannot quantify.
No, they really can't.
Yeah.
So to wrap up session 2, the baseline you are operating against on Monday morning is entirely alienated from Friday afternoon.
Completely different universe.
Right. The market has shifted from pricing in diplomatic hope and a tech-driven soft landing to defensively bracing against sticky inflation, global maritime conflict, and now severe domestic instability.
Which naturally brings us to session 3. Right. Session 3. What do we watch in the coming week?
Well, we have a very heavy economic calendar colliding head-on with this newly inflated geopolitical risk premium.
So what are the specific items on the slate from our Watch Next radar?
The absolute anchor of the week is April 28th and 29th. That brings the FOMC meeting, the official Fed policy statement, and Jerome Powell's press conference.
And for the listener, we really need to connect the dots on some vital context regarding that Fed meeting. The ongoing succession fight and the questions around Fed independence actually lost a major legal overhang on Friday.
Oh, the DOJ probe.
Exactly. Reports emerged that the Department of Justice is dropping its criminal probe into Chairman Powell regarding the Fed's headquarters renovation.
And why does that matter to the markets?
Because if the Fed chairman is under a criminal probe, investors worry the institution is politically compromised. Clearing Powell clears the runway for the markets to focus purely on the mathematical policy reaction function rather than legal distractions, right as they make this critical rate decision.
That is a vital point, Danielle, because it removes one layer of institutional uncertainty just as the bond market is about to be heavily tested.
Right.
On April 27th and 28th, we have heavy Treasury refunding supply hitting the market. This includes auctions for 2-year and 5-year notes plus 7-year note auctions.
And Treasury refunding is essentially the U.S. government issuing new bonds to pay off its old ones, right? Like refinancing a massive national mortgage.
Exactly. And the market has to digest all of that new debt issuance while global interest rates are in flux.
And then we hit the data wall on Thursday.
We do. April 30th is a massive data dump. We get the Q1 GDP advance reading, March PCE inflation, which is famously the Fed's preferred inflation gauge.
Right.
We also get the Q1 employment cost index and the weekly initial jobless claims. And finally, on May 1st, we get the ISM manufacturing PMI.
Man, that is a lot. So how should a listener synthesize all of that incoming economic data when the world feels like it's literally on fire?
You have to view every single one of those data points through the lens of the weekend's events. When you look at the GDP or PCE inflation numbers, you must weigh them against the reality of energy shocks as a lagged consumer tax.
A lagged consumer tax.
Right. If oil spikes toward $100 a barrel because of this blockade, that acts as an invisible tax that slowly suffocates consumer spending weeks down the line.
Ah, I see.
And when you watch those Treasury auctions, you're looking to see how credit spreads act as a balance sheet stress signal.
Okay, meaning what?
If corporate bonds start demanding significantly higher yields than government bonds, it means the corporate world is starting to choke on the geopolitical uncertainty.
Wow. It is an immense amount of gravity to carry into a Monday morning, which honestly brings me to this Sunday night reset for everyone listening.
Let's hear it.
On Friday afternoon, we were happily riding the AI wave, assuming the biggest market risk was Michael Burry buying more semiconductor puts. Then the weekend happened. Ceasefire talks collapsed, oil blockades escalated, and even the White House correspondents' dinner turned into an evacuation scene. As you set your alarms for Monday, just remember that AI might be able to write your code, but it still can't negotiate a peace treaty or pump your gas. Enjoy your last few hours of Sunday peace before we find out exactly how much geopolitical risk premium fits into a barrel of crude.
It is a stark reality check. And,
Yeah.
Leaves me with one final thought for you to mull over as we head into the new week.
That's that.
On Friday, Treasury Secretary Bessent made a very blunt statement regarding the tech sector. He said, it's game over if the U.S. doesn't win in AI over China.
Wow. Okay.
He views that technological supremacy as an existential priority. But given everything that just unfolded over the last 48 hours, does the market ultimately care more about the abstract future of U.S.-China AI dominance? Or will the harsh physical reality of blocked shipping lanes, exploding infrastructure, and brutal battles over critical minerals force a much more immediate reckoning?
Let us know what you think about the week ahead in the comments.